Very good evening to all of you. So, we are going to continue with profit and gains of business or profession. Um, so, it's a lovely evening. So, probably I have some question before starting. I have a question from Ayush. So, I'll start with that. So, Ayush wants to know why is sugar considered as an agriculture product and why is edible oil not? So I seriously don't have an answer for this. It is how product tax and why department has classified it. Probably one of the reason could be is the entire sugar process is agriculture in nature. It is driven by sugar cane, so it's not something a tedious process to edible oil. To become an edible oil, there are several stages, but probably the sugar is typically the entire thing is an agriculture product from where sugarcane pricing and everything is determined by the government. So it is not free to trade. So it's not something which you can freely trade. So even the pricing of the sugarcane is determined only by the government. Even the sugar prices are determined only by the government. So what prices sugar cane business people have to sell it to the public or to another company is purely determined by the government. So it has a stricter, it has more heavy control on how it has to be played across. So maybe that's the reason why it is an agriculture produce. I definitely do not know. Is there any scientific reason behind why sugar is an agriculture product and edible oil is not? So now that we have discussed about this agriculture produce and the reason of this 35 AD, we'll just give a heads up on what we discussed last class, a small recap. So what did we start with? We started with 43.1. So what was 43.1? What is 43 first? 43 is I can equate 43 to section 2. So what is 43? What is section 2? We discussed in the last class itself. What is it? It is all about, right. So it is about definition classes. So this both section 2 is definition for the entire income tax act, whereas 43 is definition related to PGBP. So what does it provide with respect to this PGBP in section 43 clause 1? It says it is basically relating to cost. What is the actual cost? Actual cost that has to be taken into the business of a particular asset. So what is the cost of a particular asset? So that is discussed in 43 clause 1. Then we discussed about 43.6, which was WDV. That is your written down value. What is the written down value of a particular asset? We saw various scenarios and how it has to be computed. And we saw when it will be nil and what will happen when it is being carried over from another owner. So we saw various scenarios, right? So that is 43.6, which discusses about WDV. And then we went on to section 35 for scientific research. We broadly said 3 categories: own company into scientific research, to a third party company, to an organization, to a third party company or to an organization, which is specific laboratories, universities, colleges, all that we discussed. And then we said that it will also discuss about the another business category. That is, I am involved in biotechnology or into manufacturing or processing, which is other than the 11th Schedule Act. So scientific research, we said 3 broad categories, where if you're spending, it is 100%. And then we discussed about 35 AD, that is your specified business. So we said hotels, right? Hotels, hospital, the infrastructure facility. We saw about pipe gas, the oil gas related laying and pipe related thing, storage of agriculture produce, cold chain facility. So we saw various activity. I guess it was around 13 businesses that was covered there. So we saw about all of them, which is basically eligible for 35 AD, where 100% capital expenditure is eligible for a deduction in the year of it is incurred. So that's what we said. So in both this 35 and 35 AD, moment you claim this deduction, you are not eligible for any other deduction, including depreciation allowance. So this is all what we summarized in the last class, right? So now, probably to move on from here, we have one more section relating to the special allowances. So that is your 35D. So apart from this, we'll start with 35D, which is called the deduction for preliminary expenses. So what do you mean by the word preliminary? So what do you mean by the term preliminary? So we're going to discuss about preliminary expenses. So what do you mean by the term? So typically preliminary expenses, as the word says, preliminary, it is before incorporation. So before incorporation, before commencement of business, not only your business as a whole, it could even be some new unit, a new extension. So it could be anything, right? Okay. So it could be a fresh activity which is being commenced. So for which you have incurred some various expenditures. So that preliminary expenses, whatever we are calling, is eligible for deduction after the business commences. So the business or the unit or the undertaking commences. So we have a provision which says the eligible expenditure incurred till commencement. So if it is commencing on 15th June today, whatever has been incurred till 14th June, till its commencement, is eligible. It could be for commencement of business or operation of extended undertaking. Let's say I have one unit, nearby I'm building up another unit and I'm starting that. So that's also some expansion, some major expansion, which will increase my production facility. So it's a new unit or an expansion that is being undertaken. So if that is also could be considered as preliminary expenses. So for this expenses, income tax says, so you can claim this over a period of time, So what is the procedure to claim? What does the eligibility? What is the condition? So we are going to see that one by one. The first thing we are going to understand is who is eligible. Who? Okay. So who is eligible to claim? So an Indian company or a person resident in India. Please understand it is only for residents. A person resident in India or an Indian company. He is eligible to claim this preliminary expenses deduction. Now, on what? So we'll say what, okay? What is he going to claim as deduction? The expenditure that he has incurred, before commencement of business. If it is relating to a new business as a whole, before commencement of business. In case if it is in connection with some extension or some new activity being that date, that is extension, undertaking or setting up of the new unit. So that date. So before that date, whatever has been incurred, whatever expenditure has been incurred, so that is what is the deduction that you are eligible. What? Now, how much you can claim? What is nothing but the expenditure. Now, how much can you claim? How much is nothing but 1/5 or 20%. 1/5 or 20%. So over a period of 5 years. Now I'm going to ask you a linking question, which what we have already understood. Where else did we see that it can be claimed over a period of 5 years? Now we are talking about section 35D, preliminary expenses, and we are saying that it can be claimed over a period of 5 years. Now tell me, where else did we learn this context of saying that it can be claimed over a period of 5 years? Tell me any other provision which you remember. Need not be business, it could be any other provision where we said that it can be claimed over a period of 5 years. So when you say 5 years, it is 1/5, or you can also call it as 20% on eligible expenditure. So that's the deduction. So 5 successive previous year from the previous year in which business commenced. So the first year will be the year in which the business commenced. So for example, if the business has commenced on 15th June 2022, this financial year 22-23, that is your previous year 22-23, will be the first year. You can claim year ending 23, 24, 25, 26, 27. So till financial year 26, 27, you can claim for a period of 5 years. So that's what we are calling it as 5 years. Now, were you able to guess what was the other section that we discussed about this 20%? Any other section that you remember where we were talking about this term 1/5? I told you one of the critical element to be to remember better the provisions is interlinking the provisions one over the other. So if you remember the provision, when you remember something like some of you, like Ayush has answered additional depreciation. For additional depreciation, it is 20%. Good that you remembered that term. So there you can link 20%. What I'm actually calling it as 1/5. Where did you remember 1/5? Some of you have answered specifically on that 1/5 itself. Rekha, Himanshu, Akash Neel, and and Magadev Bharadwaj. So all of you have answered that it is this private period interest. So the pre-construction interest. So the pre-construction interest, that is also what kind of preliminary, because it is before completion of the project. So there also the term is nothing but preliminary. So wherever we are calling this as preliminary, we are saying you can claim it over a period of 5 years. So right, it is pre-construction loan. That is where we discuss that it is for a period of 5 years. So here also we are discussing and we are saying that it is period of 5 years. So when you're talking about section 24, pre-construction period interest, you should also remember 35D. When we are talking about 35D, you should also remember the pre-construction period. So because these are all interlinked, and as differently pointed out by Ayush also, additional depreciation comes out with the number 20%, right? Additional depreciation comes out with the percentage 20%. So when you're talking about the term 20%, you can remember 35D, you can remember preliminary expenses, you can remember additional depreciation. So see how many things that are linked to 20%. So this is how you remember income tax. When you say 20%, what all I should remember? When I say 1/5, what all I should remember? Before commencement, where did we see this term? We saw this term in scientific research. We saw this term in 35AD, specified business. What happens before commencement? What do you do? We discussed about it in scientific research and in 35AD also. What did we say? In scientific research, we said we can go back up to 3 years of preliminary expenditures before commencement. You can claim that in the period of commencement. In 35AD, what did we say about before commencement? We said if an asset has been invested before commencement, but capitalized on the date of commencement, then that could be claimed as an 35AD deduction in the year of commencement. So please understand, each term has relevance somewhere else also. When I say before commencement, I can remember section 35, I can remember section 35AD, correct? So similarly, when I say 20%, I can remember additional depreciation, I can remember pre-construction period interest. When I say 1/5, I can remember pre-construction period interest in the 35D. So everywhere when I'm using a word, I can link it. I can link it and understand, okay, this is what was conveyed in the other provision. So I'm able to link it. So my memory makes it simple to say that, okay, when I remember 20, I'll remember all this. So it is all interlinked. So it's easy to remember. So please understand, this is one of the method. Probably you can actually remember so many things in a shorter way. So here, since I was talking about this amortization over a period of 5 years, I went on to question you on this other sections that you remember this. So good that some of you have answered that. So now, what did 35D say? 35D says, for who is it eligible? For an assessee who is an Indian company or a person who is resident in India. What is the expenditure allowed? Any expenditure, that is the expenditure incurred before commencement of business or before the commencement of that undertaking, that extension or the new unit or whatever it is. So that's what it is about. And how much is eligible? 1/5 over a period of 5 years. So each year you claim as 20% from the year beginning with the year of commencement. Now, we are seeing a new word. We are seeing a new word called eligible expenditure. It doesn't say 20% on expenditure. It says 20% on eligible expenditure. So we must know what? We must know what exactly is eligible expenditure. So we are going to understand what exactly is 20% of eligible expenditure. So what are there? What are called as eligible expenditure? So eligible expenditure is basically, it is classified what is common for all assessees, what is specifically for companies. So that's what you do. Now, with respect to all assessee, what does this say? It says expenditure carried on by the assessee. So when you're talking about an eligible expenditure, it must be an expenditure incurred by the assessee himself or an approved concern. What do you mean by the approved concern? Government approves that this concern can spend on behalf of them. So if that concern is also there, then it comes with it. So approved concern is a government approved concern which can also spend for someone. So that amount which will indirectly being spent by the assessee. So expenditure carried on by the assessee or the approved concern or an approved concern is eligible on what they say it is feasibility report. Feasibility report. So what do you mean by feasibility report? Whether this project could take off, whether we could carry out this project. So if you're actually going to expand, we need to understand whether expansion is required. For example, let's take an electric vehicle manufacturer, Ather. Now this Ather has one particular unit to manufacture. Let's say they are able to manufacture 1 lakh vehicle per day. So now this is their capacity. Now they wanted to know whether they need a additional unit to additional unit to be built up. So now how will they know that? They can conduct a feasibility report to see that whether this demand meets the requirement or should we meet more demand. So by meeting the more demand, whether what will be the extra cost, whether it will be feasible. So that report is called feasibility report. So it could be conducted internally, or it could be someone could be appointed to do that report also. And similarly, you have a project report. This is also something similar where you're going to start up a new venture. You're seeing what will be the cost involved, what will be the investment, what will be the return on investment, whether will I be able to meet it, how much will be the debt ratio. So all those things, right? So this project report is also important. So these are all preliminary costs. And then survey for business, market survey to understand the demand, or any other survey to understand a particular scenario in the business thing. So that is all called a survey for business. So the survey, be it market survey or any other survey, it is eligible. And then you have engineering services for businesses. So engineering services could be some technical services, installation, something related to that, something which is technical in nature. So those technical consultancy services, which is engineering related services, is also eligible. So everything, if you see, is related to setting up. You call it feasibility, you call it project report, you call it survey, you call it engineering services. All of these are related to setting up the thing. So these are the things that which must be spent either by the assessee or by an approved concern. Now, the other expenditure that we are talking about is legal charges. Of course, if you have to set it up in a place, there might be various legal requirements of framing agreements and other things. So whatever you're incurring to draft up an agreement for setting up this new plant or expanding a particular unit is all the expenditures that are covered. So these are all for all associates, be it individual, be it HUF, partnership, AOP, or whomever you talk about. It is applicable for all associates. These are eligible expenditure for all the associates. But what about companies? In addition to this, please remember, in addition to the existing expenditures that we spoke about, the additional things relating to, here also you have legal charges, but specifically related to what? Memorandum of association and article of association. So if someone is charging you for drafting this memorandum or article, that charge is also preliminary. Why? Because it is incorporation expenditure. While you're setting up a company, you draft a memorandum, you draft an article of association. So it is a setting up of company. So before you register into companies like 2013, you will have certain procedure. One of them is drafting MOA and AOA, and then printing. So probably you might have to print a set of, earlier, these days you only have to upload the online memorandum or article version. Earlier you had to print and distribute it to all the shareholders or something. So that printing charge is also applicable. Fees for registering the company. So whatever statutory fees that you are paying to register the company. So whatever fees that you are paying to ROC, that is your MCA, is also applicable as an preliminary expenses. And then you have, in case if you are listing, if you are going on an IPO, like what Zomato did or Nykaa did, or various companies that has been listing in the recent days, whatever is the underwriting commission brokerage, or whatever cost that you're incurring to involve in this public issue, be it public issue or issuing debentures. So for these things, whatever is the cost is also called as an eligible expenditure. So now the eligible expenditure incurs one part, which is for all the assessees. Another part is exclusive for a company. What is listed in company? It's very straightforward. MOA, AOA, and fee for registration. Just sit and imagine how is a company incorporated. You'll have to draft an MOA, AOA, and then you'll have to pay fees for registering the company. So this is what is listed there. And apart from them, what is listed there? The underwriting commission, brokerage, and charges. So this is for company. What is it for everyone? Everything related to whether the project will work out, whether this activity will work out, whether it will be commercially successful. What do you do for that? You do a feasibility report, you do a project report, you do a survey report. So all this is what we are talking about. And then apart from that, we spoke about technical consultancy in respect of engineering and legal charges for drafting various agreements. So these are all what you call as eligible expenditure, correct? So this is what you call as eligible expenditure. Now after this eligible expenditure, one thing that we need to understand is typically when you say this eligible expenditure, we said that it is claimed over a period of 5 years. But one thing we must understand is the entire eligible expenditure is not eligible. The eligible expenditure, whatever we are talking, as a restriction, as a limit, as something called as qualifying limit. So the entire expenditure is not just like that allowed. It has a limit. So what is that limit? We'll first understand for other assessees. We'll first understand this and then come to company. For other assessee, the maximum limit is 5% of the cost of project. 5% of the cost of project. So what do you mean by the cost of project? The cost of project is nothing but the investment in fixed asset. So whatever has been invested in the fixed asset just before the last date before the commencement, the year end before the commencement, whatever has been incurred on the fixed asset is your cost of project. So cost of project is nothing but your total fixed asset has been put into it. So if you're other than a company, your maximum is this cost of project, 5% of cost of project. So if your project cost is 1,000, how much is 5%? It is 50, correct? So it is 50. So that's what you're actually calling it as cost of project. So apart from this cost of project, what is for the company? So for a company, it is 5% of cost of project or 5% of capital employed. 5% of cost of project or 5% of capital employed, whichever is higher. So for other assessees, you only take this cost of project. So you only take 5% of cost of project. But for other assessees, that is for companies, you take 5% of cost of project or 5% of capital employed, whichever is higher. So you take whichever is higher. So that is for company. Now this is the maximum limit. So what do you mean by maximum limit? Which means your eligible expenditure cannot exceed this maximum limit. So eligible expenditure cannot exceed 5% of cost of project or 5% of capital employed. So your eligible expenditure cannot exceed 5% of cost of project or 5% of capital employed. So now what is capital employed? Cost of capital employed. So what is capital employed? Capital employed is basically your share capital, your debenture, your long-term borrowing. So if you're combining all this, you get cost of capital employed. So this, along with your 5% of cost of capital employed or 5% of cost of project, whichever is higher, subject to maximum of eligible expenditure. So it cannot exceed maximum eligible is this 5%. So that's what we are talking about, correct? So it's restricted to eligible expenditure. Now, can we do this in the manner of your house property? What did we say in house property? In house property, we said fair value or market value, whichever is higher, subject to restriction of standard rent, correct? So whichever is lower. This is what we studied for house property, correct? Now just replace fair market value, this fair value with cost of project. So 5% of cost of project is fair value. Market value is 5% of capital employed. What did we say? Whichever is higher, subject to maximum standard rent is here what? Eligible expenditure. So now you can remember both this in the same manner. So there we said fair value or municipal value, whichever is higher, subject to maximum standard rent. Here we are saying 5% of cost of project or 5% of capital employed, whichever is higher, subject to maximum of eligible expenditure. So this is the general procedure. So once you arrived at this qualifying limit, whatever you have arrived at the qualifying limit, that amount will be split over 5 years. To understand, like you will be claiming 20% every year for the period of 5 years. So when you say this fixed asset, share capital, whatever it is, the value will be nothing but last day of the previous year in which business commences. So the first previous year in which the business commences, so that's the period you actually take. Last day of the previous year in which business commences or extension is completed. So that is the period. You take 31st March of that period and then consider the total, what is the cost of project or cost of capital employed. So that's what you're actually calling it as the limit. So that is compared to the eligible expenditure. So once you know this, you are claiming 1/5. Now, so that is 35D. Now, there is another section, 35DDA. 35DDA is called as expenses for voluntary retirement scheme. We already saw in salary relating to this voluntary retirement, how it is computed and all that. Now, from the employer perspective, whatever I'm paying as voluntary retirement is a whole amount. It's a bulk amount. So this cannot be treated as 1 year's expenditure. So it has to be split. So it has to be split over what? 20%. So this is also 1/5. So now 1/5 as pre-construction interest, preliminary expenses under section 35D, and your voluntary retirement scheme under 35 DDA. So all this as 1/5. If you take 20%, you have additional depreciation under section 32, your 35D, 35 DDA. So all this comes under 20%. So that is what you're remembering this provision. So you have preliminary expenses for 5 years, voluntary retirement scheme for 5 years. When you say 5 years, it is 5 successive previous year. So from the year in which it is actually beginning, the year in which this voluntary retirement was made, from that year, next to 4 years. Same way, the year of commencement plus 4 years. So that's how you actually come to 5 years. Now with this, we have covered the basic special provisions. So that's what it is about, right? So we have covered the specified provision. So we'll answer some of the queries before we move on to other general deductions. Okay, why Madhuri wants to understand why are they giving deduction before commencement? Now, before commencement, you will not have income, right? You will not have income. So whatever expenditure you are incurring is actually not an eligible expenditure under the Income Tax Act because you have not started earning revenue, you have not commenced your business. So whatever expenditure you are incurring is not an eligible expenditure to be claimed. So you cannot claim it as a loss and carry forward. You cannot claim it as a loss and carry forward. So income tax says whatever you have done towards incorporation or towards this, you claim it over a period of 5 years. So it is also a business expenditure. But since it's relating to commencement, relating to setting up, relating to incorporation, I'll give you a benefit over a period of 5 years, not in one single year, but I'll give you for a period of 5 years. So that's why they're probably giving deduction for commencement. It is also a business expenditure, but since it was before commencement and the volume, you do not know what will be the volume of the expenditure, you're allowing them to claim it over a period of 5 years. The deduction is eligible for individual and company also. When you say company, it is like incorporation or all that. When you talk about individual, you might also be running a business. You may also expand your business, set up your business, all that. So all this feasibility report, this market survey, project report is applicable for both individuals and companies. Mansha, why are we separately mentioning as engineering services? Technical services is not about feasibility. It is about testing. You might be doing some prototype testing before commencement. Before you launch the actual production, you might be doing some testing or some kind of engineering activity which requests, which is before commencement. So for that, they are treating engineering services separately. So it is not about your feasibility report. It is about the product viability by physical testing of the product. It could be that or some kind of installation or something of that kind could also be there. So that's why engineering services is separately mentioned from feasibility report. Mansha, whether salary conducting feasibility study is included? Yes, if there is some salary cost which is towards this feasibility study, yes, you will have to include it. Who are resident non-corporate assessees? Pooja, resident non-corporate assessees are individuals, a non-resident individual, a non-resident partnership firm, a non-resident firm, a non-resident person other than the company. So the company is a separate thing, okay? Everyone else could be a non-resident individual, a non-resident, what you call a partnership firm or whatever it is. They are called as non-corporate. So non-corporates, non-residents. So when you say resident non-corporate, you mean to say individuals, HUF, partnership firm, LLP, AOP, BOA, artificial judicial person. All this fall as non-corporate. When you say corporate, it is only company. Your private limited company and public limited company are only called as resident corporates. Swati, 35 DDA is 4 years and not 5 years. No, it is 5 years. The first year is in the year in which you have incurred. Okay. So that is why the book says the year of spending plus 4 years. In total, 5 years only. It is in total 5 years. It is not 4 years. Please don't get confused to the word 4 years. The deduction is according to the law, the deduction is for a period of 5 years, not 4 years. The 5 years, the first year starts from the year in which you have actually incurred that voluntary retirement. So it is 1 plus 4. That's how your book has stated. Your study material provides that it is 1 plus 4 year. So it is 5 years. So don't get confused that as it is 4 years. Akash Neil, is it then lower of eligible expenditure or yeah? The actual limit for which can be claimed as preliminary expenses, your eligible expenditure or 5% of cost of project or cost of capital employed, whichever is lower. Swati, what are recurring allowances? Are they exempt? If exempt, what is limit? Please explain. So what is recurring allowances? I actually don't get your question. Recurring allowances. So probably try to rephrase and put it across for me to understand so that I'll get back to on that. Pooja, 5% deduction is quite small. See, I'll just tell you the cost of project will be in crores. It will be like 100 crores, 50 crores, 10 crores or something like that, right? So the 5% of that will be a very huge money. So we are talking about 5%. But on what are we computing that 5%? We are computing on the entire cost of project. So it could be running into crores. So even if you take 1 crore for that matter, it is going to be how much? 5% will be 5 lakhs, right? So that is how the quantum will be there. So that is how we are saying that the 5% is on the entire cost of project. So your expenditure should be less than this. So that's how the limit that is being there. Nega, what is vocation? So I guess it is a question like at least 3 classes before. Vocation is form of profession. It includes your painting, sculpting. Particularly, we can keep it this way: a profession where you don't need a formal education, but it is a proper skill set. If you talk about painting, it is a skill set. For example, I am a very poor painter. You could see my handwriting, how poorly I'm writing. So I'm a very poor painter. Now, I can never become a painter, right? So now, but whereas various people will have that capacity within them from the beginning itself, there will be a painter from the beginning. It will be internally in them where they'll start drawing or painting from a very young age or something. So these things does not require actual formal education, does not require formal education. So that's why you call these as vocation. So some of them are painting, astrology, sculpture. So these are basically called as vocation. Rekha, if there is a loss in first year of commencement, then this loss of 20% is carried forward. Yeah, the 20% is part of your losses. The 20% is part of your losses, but it is not like your unabsorbed depreciation or unabsorbed scientific expenditure or whatever it is. It is only limited to, if it is carried forward for 8 years, it is only 8 years. If it is 4 years, it is 4 years. So I'll not get into the number of years that could be carried forward because it's a separate chapter by itself. So for you to understand right now, I would say that 20% will be included part of your expenditure, even if it is a loss. And that loss will be carried forward to the eligible number of years. Okay, so that's about preliminary expenditures and your voluntary retirement scheme, 35 DDA. So now we'll move on to the other directions. So when we spoke about the structure of business, we said 30 to 37 are admissible deductions. Admissible deduction. So we are discussing in that section only. We already discussed about what? 30, 31, 32, 35, 35 AD, 35 DDA. So we have covered all these sections in 30 and in the range of 30. And for your exam purposes, I would say what will be important is only this. Other than that, is typically a final chapter. The 35, 35 AD, 35 DDA and all is more of final. But I will not say completely ignore it. So that's why I've taken it a bit. But primarily your exam questions could be related to this 30, 31, and 32. When you talk about individual businesses, primarily it will be 30, 31, and 32. Okay. So now we are going to understand 36. 36 is called as other deductions. That is other permissible deductions. Okay. So which means whatever we have not discussed till now from 30 to 35 DDA, we are going to discuss in 36. So the 36 first thing that we are going to discuss in 36 is insurance premium. Insurance premium. So what is insurance premium? I definitely need not explain you what is insurance premium. Of course, I will not explain. But I'm going to explain you two categories of insurance premium that are eligible with respect to business. Please remember, not all insurance is allowed. Just only two categories of insurance is allowed with respect to business. The first one is you're taking an insurance for stock or stores. If it is very difficult to read, I'll just write it here. Stock. So if you have any stock inventory, so if you're taking an insurance against that inventory, against what? Insurance against risk of damage. So the first thing is damage and then destruction of stock. So the DD, right? So for damage or destruction of stock or stores, which is used for the business, that insurance premium is eligible. That insurance premium is eligible. Where another category of insurance is health. Okay. So with respect to health, to keep up the health of employees, so to keep up the health of employees, if you are paying premium, it is allowed. Please remember, this insurance is not allowed if it is in cash. So it is not allowed if it is in cash. So please remember, this insurance, similar, I will not link with any other product. So I'll just continue with this. Premium paid by cash is not allowed. When you are understanding other provisions later point in time about this premium itself, like ATC, ATD and all, please understand what all provision cash is eligible, what all provision cash is not eligible. Just segregate provisions between where cash is allowed, where cash is not allowed. This is one provision where cash is not allowed as an expenditure. So the health of employee, it is for the to keep up the health of an employee. If you are paying any insurance, it is an allowed expenditure, but it must not be paid in cash. So these are the two categories of insurance that is eligible. What are they? Stock or stores for damage or destruction. Health of an employee, to keep up the health of an employee, not paid in cash. That is paid through non-cash mechanism. So these are called as eligible insurance. So this is the one I have driven here. I have specified here as clause, but for examination purpose, at your intermediate level, you are definitely not required to quote the clauses and all in specific. But if you are able to, there is nothing like that. But it is not something mandatory. One advice that I'll give you is don't quote wrong clauses. Whatever section number or clauses that you're quoting, make sure you have the confidence of writing it exactly, or it is better you just leave it and write the provision alone without specifying the clause or something. So that's what it is, because writing it wrongly gives a completely different negative impression, but whereas not writing doesn't give that impression necessarily. So that's what it is. So that is 36, insurance premium. The next 36 that we are going to talk about is contribution to provident fund or other funds. So this 4 and 5 is related to employer contribution. Employer contribution. So it is basically contribution to recognized provident fund or an approved superannuation fund or a gratuity fund. So these are all the funds falling under this clauses. So whatever is contribution, it will be on definite basis on salary. For example, if you talk about our provident fund, what did we study in salary? How much is basically your provident fund deduction that we are talking about? A number that we are talking about as part of the salary, basic salary plus dearness allowance. We discussed what? 12%. So 12% is what is an eligible deduction for contribution of recognized provident fund. Similarly, you have superannuation, gratuity fund. So this is deducted on, this contribution is made on definite basis. So whatever is being paid by this employer is exclusive benefit for employee. So whatever you are spending towards this contribution to PF, it is exclusively for the benefit of the employee and nothing else. So this is purely the contribution by the employer for the benefit of the employee. So this is the employer contribution. So whatever is being paid under employer contribution is allowed as a deduction. It's an eligible expenditure. And next one is employee contribution. So what exactly is employee contribution? As far as this PF goes, when an employer is contributing, employee can say equally contribute for me also. So it will be deducted from the salary and deposited to the provident fund. Now, this contribution from employee or for the relevant fund should be paid exactly within the due date, which means if you are paying belated, you are paying delayed, then you are not eligible. So you should actually be credited on or before the due date of the relevant fund. So typically for PF and all, the due date is 15 days. So for May month, what is the due date today? So for May month, today is the due date for depositing a provident fund. So 15th June. So no extension or nothing. The exact due date in which has been specified in the relevant act, the PF act or whatever it is, that date is relevant. So generally that is 15th of subsequent month. So if it is after the month end, that is after May end, it is 15th June. After June end, it is 15th July. So this contribution is eligible as a deduction only when you are paying it within the due date specified in the relevant act. Please note this very critically. When we are seeing this a little later under another section, 43B, I'll come back to this statement because there is an amendment in that. So I'll come back to that. So please understand this. Please understand the difference between the employer contribution and employee contribution. In employer contribution, I am not using the word it must be paid within the due date specified in the act. I am not saying that. But in the employee contribution, I am saying the word it must be paid within the due date specified in the act. That is 15th of subsequent month. It is mandatory. So if you are paying it on 16th, it is not allowed. Whatever you have paid it on 16th June for May month is not an eligible expenditure for the business purposes. So that is the importance between employer contribution and employee contribution. This applies for provident fund or any other fund, but in the aspect of superannuation or gratuity, there is no employee contribution. Employee contribution is generally only in provident fund. There is no other fund which has employee contribution. So that is your next category, contribution to provident fund and other funds. So now we'll move on to the next section in 36. So just a second, I'll see if there are any doubts on this. Why there is a voluntary retirement, the commencement? Janavi, voluntary retirement is not on commencement. I'll just give you an example. So 35 DDA says, let's say 10 employees are going on VRS. For this 10 employees, I'm spending, let's say 75 lakhs. Okay, let's say I'm spending 75 lakhs for this 10 employees. Now, income tax says, don't claim the 75 lakhs in one single year. Let's say this was paid on, let's take what date? Some date, 15th June 21. That is what? Financial year 2021. So 35 DDA says, claim 20% for 5 years. So when you say 75 lakhs, 5 divided by 5 is 15, right? So 15 lakhs from financial year 2021, financial year 21-22, financial year 22-23, financial year 23-24, financial year 24-25. So 1, 2, 3, 4, 5. So this is how you claim this voluntary retirement. So for a company, it is not about commencement. Whenever you are paying voluntary retirement to various employees, that amount will be claimed over a period of 5 years, will not be claimed as 1 year expenditure. So that's what it is. Hope it is clear now. Snega, share capital, yeah, it is issued share capital. So for share capital, we'll have to take issued share capital. Swati, in Army employees, I said there is allowance of recurring allowance per month, 26,789. Is that exempt? It is not exempt. We have already discussed what alone is exempt. This recurring allowance provided there is not exempt for them. For Army employees, only there's attitude allowances and all are there for Army employees which are eligible. Ankur Singh, yeah, premia means premium. Premia is a technical term for premium. Hitesh Jain, is this insurance premium applicable on livestock also? Yes. So generally in some of the sections, it specifically tells you where the livestock is not an eligible expenditure. But here in this section 36, it very clearly says the entire stock and stores. It doesn't talk about what is exempted or something. So the entire stock is basically eligible as your thing. So that's what it is. So other questions? Yeah. So insurance for loss of profit is not eligible. No. Arshita, insurance for loss of profit is not eligible expenditure. We'll just see another section where probably we can see whether it will come under that or not. Here, whatever we are talking about is only two things. Whatever I'm not covering here in this insurance 36, probably we'll discuss in 37. Sometimes it might get covered there also. So whatever is towards loss of profit, please hold on to it. When we are discussing section 37, we'll come to that. Raghavan, what is meant by superannuation? It is for a allied club of employees, let's say who's holding a higher authority or something, superior positions or something. Company feels that they must be additionally contributed beyond everything, beyond PF, beyond gratuity, beyond everything. These core employees must be additionally contributed in form of some annuity. So superannuation is a form of annuity. So the time of retirement or something, it goes to that employee. So it will generally be for very specific employees, not for all employees. Akash Neil, if employer's contribution to PF eligible for deduction are only 12%, here whatever you pay is actually eligible. There is no restriction on 12% here. So whatever you're actually contributing to the provident fund is eligible. Only in salary, when you're calculating this for the employee, you'll have to bring the 12% criteria. For here, for this PF in section 36 that we're talking about, whatever is the PF contribution is eligible. What is ad hoc payment and how it amounts to employer's contribution? See, whenever you're talking about employer contribution, it will only be a defined basis. It will not be some random number. So it will be some exact working which only will be contributed. I don't know whether there will be any ad hoc payment. Ad hoc payment is some random payment. Suddenly I feel today I pay up 12,000. So the moment I pay 12,000, I am paying short of what I'm supposed. Let's say I'm supposed to pay 15,000, but I'm only paying 12,000. It is a short PF contribution. So for employer contribution, there is another provision which says if you are paying it within the due date of return, it is still eligible. So for employer contribution, whatever you are contributing is actually claimed as deduction. Pooja, if employee contribution is paid late, then yeah, your understanding is right. The company does not get deduction of an expenditure if they are paying it late, even by 1 day beyond the due date specified in the Provident Fund Act. So nothing else, Provident Fund Act. Mansha, what is the intention of provision of 3615A? Now, employer contribution is company's own money. So it doesn't matter. But this amount, the employee contribution that you're talking about, is actually deducted from the employer. Generally, what happens is when the salary is fixed, they'll say, see, your total is 12,000. Let's say total is 50,000 per month. Out of this 50,000, your basic, your HRA, your other allowances, and your PF. Now, this will be the breakup. Now, let's say that the basic is 20,000 and PF is 2,400. This 2,400 will not be given to the employee. It will be given to the PF organization. So, which means this 2,400 is actually employees' money, but it has to be deposited to the Provident Fund. Now, if the company is not depositing this, they are misusing employees' fund. So it is a very critical issue. So even if it is 1 day, government says it is not your money, whatever is the money of that employee deposited. Because the month salary is due on every month end, right? So 30th or 31st or whatever day it is. So now you have to deposit it to the PF. So even if there is a delay, 1 day delay, it is not company's money, it is employee's money. So you're misusing someone's money. That is not encouraged. So that is why there is an exclusive provision for employee contribution alone. Okay, so that's all the answer for this. So I'll move on to the next provision of 36. That is about bad debts. So what do you mean by bad debt? I don't need to explain you again. So you have all come across your 12th standard public exam. You would have all studied this bad debts, how to account, what will be the entry for provision for bad and doubtful debts, what will be the accounting entry for bad debts. All that you would have been prepared. It will be in your fingertips right now. What I am going to tell you is from the income tax angle. From the income tax angle, what do you do when it is bad debts? So basically, bad debts is accounted, right? So it's accounted. Whether this is allowed as a deduction, whether it is allowed as a deduction or not is a question. Income tax says it is allowed. So whatever is a bad debt, which is written off as irrecoverable in the accounts, whatever is written as bad debts in the account is allowed as a deduction. So today, if I'm saying 1 lakh is a bad debt, I am eligible to claim it as a deduction. So 36 subsection 2 says deduction shall be allowed if bad debts are incidental to the business of the assessee, which means the bad debt that I'm talking about should be relating to the debtor of my business, not something else. It should be relating to a party, relating to a customer, client, or whatever you call, relating to a debtor pertaining to the business transaction. So it must be relating to the business, day-to-day affair of the business. So that bad debt is only considered as incidental. So that is only allowed. Now, bad debt has been considered for computing income of that previous year or earlier previous year. What do you mean by that? So typically, what do you mean by bad debt? I'll speak a little bit of accounting. So when you're actually booking, let's say, let's call it Ramesh, okay? Ramesh debit to I'll just keep it as sales, okay? I'll write 1 lakh. So this date, I'll keep it as 10th May 2018, okay? I've kept it as 2018. Now I'm repeatedly following up with Ramesh, give me payment. So today we are on 31st March 2022. Till date, I'm very sure Ramesh is not going to give me money, okay? Ramesh is not going to give me money. So what do? I do bad debts, debit to Ramesh. Correct? Now, the provision says it is treated as an income in the previous year or earlier previous year. So now what has it been treated? It has been treated as an income in financial year 2017-18. Correct? So it has been treated as an income in financial year 17-18. Whatever we have sold it to Ramesh, it has been treated as an income in financial year 17-18. I am treating that as a bad debt in financial year 21-22. Clear? So that's what the provision says. So it must be an income of the current previous year or some other earlier previous year. So that's what it is said. And the debt should represent money lent in the ordinary course of business of money lending or banking carried on by the assessee. In case if it is relating to whatever transaction, whatever we are calling bad debt, should be in the ordinary course of business, be it sales, be it loan. It could also be loan or something which you have given. Whatever it is, it should be in the ordinary course of business. The debt should represent money lent in the ordinary course of business of money lending or banking carried on by the assessee. So it could either be his own business or if it is banking or something. So if it is related to loan, they must be in the business of banking. Why? Only then it is an income transaction. So typically, to keep it short, it must have been an income in some earlier year. So that's what the provision says. So provision says it must have been an income in some year. That only should be considered as bad debt. Now, you need not establish, no requirement to establish that the debt is irrecoverable. So you need not prove to anyone saying that, see, I called him 20 times, I mailed him 40 times. You need not prove it to anyone. So all you need to do is, you know whether you took a sincere attempt or not. If it is bad debts according to you, if it is bad debts according to you, when I say you, the assessee, if it is bad debt according to the assessee, it is okay. You need not prove anyone to establish it is actually a bad debt. Looks easy, right? Today, suddenly I wanted to reduce my profit. I book a bad debt and reduce my profit. It's so easy, right? So it's as simple as that. But there's a small check to this that you cannot do as you wish. So the check is basically what happens when you're actually collecting it back. You have considered something as bad debt. What happens when you're actually collecting it back? There are two scenarios. One is, now we'll just replace this, okay? We'll replace this 1 lakh with 40,000. So now I actually think out of 1 lakh, or yeah, I've rephrased. So out of 1 lakh, I think 40,000 will not come to me. I think 40,000 will not come to me. I'm thinking 60,000 will be settled by me. Okay. Now, what the provision says is the shortfall shall be deducted in the previous year in which ultimate recovery is made. So now, let's assume on 15th June 2022, Ramesh is paying me. Bank account debit to Ramesh. Ramesh, how much? Let's say he has given me 60,000. Sorry, not 60. He has given me 20,000. So now, out of 1 lakh, I thought only 40,000 is going to be my, what you call, my 40,000 is going to be bad debt. But now how much is actually my bad debt? 80,000 is my bad debt. Okay, so we'll change this amount for convenience. So 35,000. So out of 1 lakh, 35,000 is received. So the balance recoverable is 65,000. Out of 65,000, old bad debt is how much? 40,000. So current year, I can claim another 25,000 as bad debt. So in the year, financial year 2022-23, I can claim another 25,000 as bad debt. Why? I have already considered 40,000. Now, according to current statement, 65,000 is outstanding and it is not going to come. So I'm going to increase my bad debt by another 25,000. So that's what it says. If ultimate recovery is less than the debt itself, debt minus deduction allowed. So that is 1 lakh. In our case, it is 1 lakh, correct? 1 lakh minus 40,000. So it is 60,000. But how much I have actually recovered? I have recovered 35,000. So my 35,000 is less than 60,000. In that case, the shortfall, the balance 25,000 is an additional bad debt. Clear? Very simple. Now the reverse case, we'll rephrase the numbers. Okay. We'll treat this number as, instead of 35,000, we'll assume that what I have received is 70,000. What I have received is 70,000. So now what happens? 1 lakh minus 70,000 is how much? 30,000. But how much is old bad debt? It is 40,000. So 10,000 is excess recovered, correct? Excess recovered. Now this 10,000 becomes an income. So what am I saying? I'm saying this is how much I've recovered. What did I say? How much did I recover? I recovered 70, correct? I recovered 70, but my bad debts is actually 100 minus 40, 60. So the balance 10,000, is the excess received. I thought it is going to be a bad debt, but Ramesh is a very good person. He has given me 70,000 beyond what I thought he will give me. So this 10,000, this excess shall be charged to business income under section 41, clause 4. So 41 is a deemed income section. Deemed income section. So this 41 says that whatever you have excess recovered becomes taxable, and 36. Clear? So that is about your section 36. That is about your bad debts. So that is what? Section 36, 1 clause 7. Okay. Now, few other deductions under section 36, various sections. What are all the eligible deductions? Bonus or commission. What does it say? It is paid to an employee for service rendered Otherwise, it would not have been distributed as profits. Why is this line given? Typically, profits distributed as dividend generally attract additional tax, because dividend person who's receiving dividend also should pay tax. Person who's earning that profit also should pay tax. So there is a double taxation possibility in distribution of dividend. So now, if I'm actually distributing as dividend, let's say to a person, let's say he's a managing director, he also has shares. Now, instead of giving him as dividend, I'm giving him as this bonus or commission. So they say whatever is bonus or commission is eligible, but let it be for the services rendered, not as a part of repaying profit in the manner of profit. How do you identify? It is typically very difficult. Unless you actually audit the books of accounts, you will not be able to understand whether it was form of profit or actually a bonus. So for exam purposes, for theoretical purposes, for bonus or commission, all you need to understand is if it is paid to an employee for services rendered, it is allowed. So that's what it's about. Next is interest. So any interest for capital borrowed for the purpose of business. Capital borrowed for the purpose of business. That is your working capital, buying an asset, or whatever it is. So that is allowed. If it is related to an asset, we already studied earlier itself. What did we say? It is allowed only till the asset is actually put to use. Till the asset is put to use. Where did we see this earlier? Till the asset is put to use. We saw in section 43(1) relating to actual cost. So whatever interest till it is put to use, whatever asset the interest cost till the asset is put to use can be capitalized. So it is not allowed as a deduction. So whatever is incurred on an asset after capitalization is only claimed as an expenditure under section 36. So that is about interest. And then we have discount on zero coupon bonds. Discount on zero coupon bonds. What do they say? What do you mean by this discount? First of all, zero coupon bonds. I'll just give you an example. Typically, what happens is, let's say a bond value is 100. I will actually pay 96. Okay, I will actually pay 96. Now, this 96 during maturity, they will pay me 100. So technically, my income is 4, because I'm only paying 96. This 4 rupees is like I'll be giving at the time of maturity. So what do they say? Deduction of discount on pro rata basis. So whatever discount that is being given, so now the company says, I'm not giving you at 100, I'm giving you at 96. So the company which is issuing the bond, the 4 rupees is a discount. The company which is issuing the bond is issuing that 4 rupees discount. So this 4 rupees will be claimed as a deduction over the period of the bond. Let's say the bond is eligible for 4 years. Now every year you claim 1 rupee for 4 years. So that's what you're actually calling it as. You'll be claiming every year 1 rupee for the period of 4 years. So that's what you're actually calling it as. Discount is equal to received minus payable on maturity. What did I receive? I received 96. How much should I pay on maturity? I should pay 100. So this 96 minus 100, that cost of 4 rupees is what is actually claimed as over a period of this period. So that is discount on zero coupon bond. Pension scheme. Whatever contribution employer is making to a pension, fund, that is 80CCD. Okay, pension scheme under 80CCD. So national pension scheme. So that we saw in salary also, right? It is restricted to 10% of salary. So the employer contribution, it is generally restricted to 10% of salary. When you say salary, it includes dearness allowance forming part of retirement. That is your DAFE. So this dearness allowance, 10% is only allowed. Whatever is excess beyond 10% will be disallowed under section 40A clause 9. So what is eligible as deduction for the employer is only 10% of basic salary plus dearness allowance. Anything above that is actually a disallowance under section 40A clause 9. And then you have family planning that is only eligible for companies. This provision is not eligible for others. So that's what it is about. So it is only applicable for companies. Now the expenditure on promoting family planning is what is there. And this is also something like your voluntary retirement scheme only. So what did we say? Whatever you spend, it is claimed over a period of 5 years. So this is also for a period of 5 years. So now how many sections are there for 5 years? You have section 24, pre-construction period interest. You have section 35D, preliminary expenses. You have 35DDA, that is voluntary retirement scheme. Now you have section 36. We are also talking about 5-year period. So all this are period of 5 years. So 20% for 5 years. So 20% for 5 years in case of capital expenditure. So whatever family planning, capital expenditure can be claimed over a period of 5 years. If it is your regular revenue expenditure, it is in the same year, 100%. Only capital expenditure is claimed over a period of 5 years. Whatever is unabsorbed, if you don't have sufficient losses to set off this family planning, like your depreciation, like your scientific research, this also is unabsorbed for n number of years. So whatever is unabsorbed relating to this family planning expenditure can be carried forward for n number of years, like your unabsorbed depreciation. The last one is security and commodity transaction tax. Securities transaction tax, commodity transaction tax. It is a tax levied by the stock exchanges for you transacting in security market or commodity market. That is an eligible expenditure to be claimed as an expenditure under section 36. So whatever you are spending, whatever is being paid by the assessee is eligible as security transaction tax or commodity transaction tax. So that's what this is about. So we'll see a small problem to understand this, some of the sections. So it says X Limited contributes 20% of basic salary to the account of each employee under pension scheme referred under section 80 CCD. Dearness allowance is 40%. Dearness allowance is 40% of basic salary and forms part of its employee. Correct? So it is forming part of employee. Now out of this, then they say we have to compute what is the eligible deduction under section 36(1)(5)(a). So now, according to 36(1)(5)(a), if the basic salary of whatever is pension is covered, whatever is pension fund is covered, we said maximum eligible is only what 10%. Beyond that, it is not allowed. So now we need to understand what is actually eligible as this deduction. So what is eligible? So we'll have to first calculate what is the actual salary for the purpose of this. So basic is how much? 10 lakhs. Plus DA. DA is 40% of that. So it is 4 lakhs. So it is 14 lakhs. Correct? In this 14 lakhs, the contribution by employer is how much? 20%. 20% of 10 lakhs. So it is 2 lakhs. It is 2 lakhs, correct? Contribution is 2 lakhs. Less what is eligible? Eligible is only 10% of 14 lakhs. So that is 1.4 lakhs. So the 60,000. So out of 2 lakhs, 1,40,000 will be claimed as an eligible deduction. In that 10%, in that 10% is 1,40,000. That is 14 lakhs into 10% is 1,40,000. And then you have 60,000, the excess contribution, whatever is disallowed under section what 40A9. So 40A9 is 40A9 will be 60,000 because that is beyond the 10%. So 36 says only your 10% of this 4A. 4A says only 10% is allowed. So whatever is beyond that, only 10% is actually allowed. So beyond that is actually disallowed. So that's what we have computed in this particular section. Okay. So we'll move on to the next section. That is section 37. This is the last section. This is the last section of the period that we are talking about as 30 to 37. So I'll first discuss about each of the list that has been specified here. So basically, what is eligible as general deduction under section 37? We'll call this as miscellaneous provision. Miscellaneous provision. So whatever has not been covered under 30 to 36 will get covered here. But only if it is actually an expenditure. If it is actually an expenditure and it is not something relating to losses or reserve creation. So it is not related to booking losses or reserve creation. Whatever we are talking here is actual business expenditure. Actual business expenditure. The first condition that they are listing is it is not a deduction specified under section 30 to 36. So 30 is repair, rent, maintenance of your building. Then 31 is about plant and machinery, repair and maintenance, insurance, rates and taxes of your plant and machinery. 32 is depreciation. 35 is scientific research. 35D is specified business. 35 AD is specified business. 35D is preliminary expenses. 35 DDA is voluntary retirement scheme. 36 is other deductions, your bad debts, PF, your interest, all those things, right? Bonus, commission, all these things are discussed in 36. Now, apart from this, if there is any expenditure, that will get classified under section 37. But that expenditure should not be in capital in nature, should not be a capital expenditure. It should be a revenue expenditure. And it should not be a personal expenditure. It should be for the purpose of business. It should be for the purpose of business. When you say business, it should be wholly and exclusively for the purpose of assessee's business. The business in which assessee is carrying. The business carried by the assessee. The business commenced by the assessee. That is after commencement. After commencement, you are incurring. So it is commenced by the assessee. It is incurred by the assessee. So these are the conditions. So it must be wholly and exclusively for the purpose of assessee business. What do you mean by that? The business should be carried on by the assessee. The business should be commenced by the assessee. The expenditure should be incurred by the assessee. So that's what you're actually calling as wholly and exclusively for the assessee's business. And the next one is the business expenditure that we are talking should be for the accounting year. So it should be incurred in the accounting year. So it should have been spent in the previous year, 21 to 22. It should be for this year. It should be for this year. Remember in your 11th and 12th standard accounts, you would have studied about accounting for prepaid expenditure. Why are we segregating prepaid expenditure? Because it is not relating to the year in which the business is operating. So that prepaid expenditure is not for the accounting year. So you're keeping it aside in the balance sheet. So similarly in income tax also, whatever you're claiming under section 37, it should be an expenditure for the relevant accounting year. For the relevant accounting year, it cannot be for any other period. So the prepaid, whatever the accrual and all, the prepaid or whatever it is not actually allowed. And last condition is, it should not be an offense or prohibited under law. Just remember, when it comes to income, illegality is okay. When it comes to income, illegality is okay. But when it comes to business expenditure, offense or prohibited under law is not allowed. So illegality, income is allowed. Expenditure is not allowed. So income is taxable. Expenditure is also not eligible. So which means if you have earned an illegal income and if you have spent some expenditure on that, that is not allowed. So which means your entire income is straight away taxable. So that's what you're actually calling as eligible. Even if it is illegal, if it is expenditure, it is not at all allowed. So it is not an offense or prohibited under law. So these are the conditions of section 37. So what does it say? It is not an expenditure described under section 30 to 36. It is not capital in nature. It is not personal in nature. It is wholly and exclusively incurred for the purpose of business. So when you say wholly and exclusively, the business is carried on by the assessee. The business is commenced by the assessee. It is incurred by the assessee. And the expenditure should be for the accounting year. So it could be accrual or something. It should be for the accounting year. And finally, it should not be an offense or prohibited under the law. So that's what is section 37 about. Now, after a short break, we will proceed with the other understanding of section 37. So this is the overall understanding of section 37. After the break, we'll understand the other understanding of section 37. So we'll see after a short break. Yeah. So yeah, welcome back. So we'll continue with what we are dealing, but we'll first answer some of the questions. Mansha, Form 16 calculation will be based on 20,000 or 50,000. Which number is that? See, whatever we are discussing now is from the employer's angle. So it has nothing to do with the employee, whatever we have discussed earlier in the salary chapter. So what we are discussing here is only what should the employer do. So whatever we have discussed earlier, the provisions of PF, pension, that is, if more than 12% has been deducted, it is treated as an income in the hands of employee. All that is in the hands of employee. So whatever we have discussed there, that applies there. Here, what we are discussing is from the angle of employer. So these are two different scenarios. So whatever we are discussing, please understand here, whatever we are discussing will not impact the salary chapter. Whatever we discussed in salary chapter will not impact your business or profession chapter. So it has nothing to do with these things. Puja, bonus commission. See, bonus is basically what you're contributing to your employee for doing an excellent work, right? So whatever has been contributed, if you feel they've done an excellent work, you give some extra money, probably 1 month salary or 2 month salary, or as a percentage of the annual salary, whatever it is. So this bonus or commission is an eligible expenditure. Is an eligible expenditure. Similarly, commission is also an eligible expenditure. So that's what is relevant as far as the provision goes. Arshi Gupta, how can a company do a family planning section 36? See, whatever we are talking here, it is not about what company is doing. Company is spending for, probably it could be for the employees or whatever it is. So for the employees, company is spending certain expenditure on family planning. So it is not for the company. It is for the employees of the company to do some family planning for the employees of the company. So where we say that if it is relating to some capital expenditure on such exercise, it is allowed on 5-year basis. Otherwise, it is allowed on the same year. Pooja, the question gives only the clauses and it does not actually give you what it is talking about. I guess you will understand more or less from the provision itself. So, for example, in this provision, the provision itself talks about how much deduction is allowable. You know, once you see this 20% basic salary, 40% DA, and you know that it is going to be relating to about the 80 CCD, you know that it is national pension. It is about 10%. So, moment you know what subject it is in some area, for example, 80 CCD is about pension. So the rest of the section also should somewhere be related to that pension only. So more or less, you must know certain sections to know what exactly it is, but it is very rare. Typically, a question like this only with section numbers and not relating anything to the topic is a very rare phenomenon at the intermediate level. So preferably, even if there are some section numbers question, it will be a commonly known sections. So I guess it will be easy for you to understand what topic it is. Rekha, if business is not commenced by associate but purchased from some other, then can we claim under 37 revenue expenditure? See, the preliminary expenses that we are talking is only when you are commencing the business. It is not when you are acquiring the business. So it is only relating to before commencement. So when you say you are purchasing the business, the process in which you are purchasing, whether to purchase or not, whether to buy this business or not. So all this is kind of a preliminary expenses. So the moment you purchase and you take it on your own, that day becomes it is yours. So that period will be called as preliminary expenses. Probably in final, you will know a little bit more than that relating to amalgamation demerger expenses. That will exactly tell you this question that you're asking about. Otherwise, as far as this, when you're acquiring the business, that doesn't come under 37. So that 37 is only about wholly and exclusively for the purpose of business. If it is relating to an expenditure which is being done for acquiring a new business, that is also preliminary in nature. That section will be covered in your final chapter, where it is about preliminary expenses in case of amalgamation demerger. It will come under that. It will not come under section 37. Mansha, whether CSR expenditure will come in the immediate next slide, we'll talk about it. So when we are talking about the section 37, we said that 37 is basically a general section, right? Not covered under section 30 to 36, not capital in nature, not personal nature, wholly and exclusively for the purpose of business. It is for the current accounting year, and it is not offensive or illegal. So this is what we prohibited by the law. So this is what we saw, right? Now there are specific expenditure under section 37 which says it is an eligible expenditure, and some cases it says it is not an eligible expenditure under section 37. So we'll see various things. So expenses on various occasions, religious occasions, are not personal nature. So though it could be a function of Diwali or whatever, Bakrid or something, could be a specific religious function, but it is not personal. It is for the business, because the employees could be of various religion, right? So it is also business expenditure. Professional tax paid is a business expenditure. Expenses on importing training to apprentices. So training expenditure is also there. Fees paid to ROC for is an expenditure eligible under section 37, provided it is not for enhancement of capital, because it is enhancement of capital is preliminary in nature. Enhancement of capital is preliminary expenses in nature. So every other ROC expenditure can be claimed as a revenue expenditure. Annual listing fee paid to stock exchanges. Expenditure on advertisement in souvenirs. So that is also there. Interest payable on unpaid purchase consideration. What do you mean by unpaid purchase consideration? Let's say that I have purchased a property. The guideline value of the property is the stamp duty valuation is actually 1 crore. But I have actually purchased it only for 80 lakhs. So this difference of 20 lakhs is called unpaid purchase consideration. So if I'm repaying that at a later point in time, the 20 lakhs, whatever interest is payable on that is also called as deduction eligible under section 37. Payments made to bona fide profit sharing scheme, rebate on the consumer cooperative stores to their members. So these are all general expenditure which are categorized. Let's not go into each one of them in detail. So we'll just stop there. And advertisement in souvenirs for political parties is not an eligible expenditure. CSR expenditure is not an eligible expenditure. So whatever you're incurring for CSR accounted in P&L is not an eligible expenditure. And freebies to medical practitioner. So samples provided to medical practitioner is against law. It is not actually an allowed expenditure. So it is not eligible. Premium on key man insurance policy is an eligible expenditure. Expenditure incurred on abandoned feature films. So let's say a producer has produced a film. It's been 3 years now. He's not able to release the film at all. Now he is abandoning whatever he has incurred towards that expenditure. He's not going to earn anything. So that expenditure is actually a revenue expenditure. So that's what it is about. So whatever is a film that didn't take that wasn't released, expenditure incurred on such film is also a revenue expenditure. So please note down all of these. Let's not have any questions on any of these, because these are all simple, not simple. These are straightforward line items. In case if it is questioned, you will have the exact lines, you will have the exact words, you will have the exact phrases. So nothing to worry about. So these are allowed. Certain things are not allowed. So that is what is discussed in this particular provision. So that is all about your section 37, which is a miscellaneous section. So we'll move on to the next deduction, that is about section 40. Here we are not talking about deductions. We are going to talk about what is not deductible. What is not deductible in 40 is going to be discussed in section 40. So now we are moving on to the next category. Section 30 to 37 was about admissible deductions. Now we are moving on to section 40, which talks about not deductible, amounts not deductible. The first thing that we are going to discuss about is TDS, non-compliance with respect to tax deduction at source. So that is discussed in subclause 1 and 1A. As far as this TDS goes, it could not be deducted. So what exactly is TDS? Before you understand this in an exclusive chapter, a basic understanding is it is tax deducted at source, which means when someone is paying you an income. Let's take an example. I am an auditor. I am an auditor. Now my client pays me 10 lakhs as a fee. Okay, 10 lakhs as a fee. Now when they are paying me this 10 lakhs, client will pay me 90, remit 10, sorry, 9, I'll keep it as 9. 9 lakhs and 1 lakh. So 9 lakhs, when I just remember this lakh, I just remember someone questioned me whether you can write it as lakhs in problems. No, you have to write the exact numbers. If it's 2 lakhs, it is 200,000. That's how it has to be. You cannot write it as 9 lakhs. In theoretical questions, you can use this, but when solving problem, you are not supposed to write in lakhs. You are supposed to write in 00. So you have to write the absolute numbers. So 9 lakhs, 1 lakh is the thing. So 1 lakh will be paid to as tax to government. So on behalf of me, government will pay 1 lakh to government. Government will pay 1 lakh to government. So this 1 lakh will be a credit. This 1 lakh will be a credit, and this 9 lakh is what I'll get the money. So what happens is, this is a procedure. When this client is paying me 10 lakhs, they are supposed to pay me 9 lakhs and 1 lakh to the government. They are supposed to pay me 9 lakhs and 1 lakh to the government. So this is what they must do. Now the provision says, if you have not done this, either paid me the entire 10 lakhs or you have paid me 9 lakhs and you have not deposited 1 lakh to the government. It could be any way. So the provision says, if you have not deducted, that is 1 lakh is not deducted. The entire 10 lakh is paid to me. So that is one first situation. The second situation is not paid. So the 1 lakh is not paid to the government before the due date of filing return. So it is not 31st March. It is due date of filing return. So what is the due date of filing return? The due date, if it's an individual, it should be 31st July. If it's a company, it's a different date, right? 30th September, 31st October. You have various due dates. So generally before the due date applicable to the assessee, if it is not been paid, if TDS is not paid within the due date, then certain expenditures are not allowed. So for example, in this case, 10 lakh is an expense to this client, right? So the expense to this client is actually 10 lakhs. Now this 10 lakh, it's not allowed. It's not an allowed expenditure because I have not deducted TDS on the 10 lakhs. So this is the provision. So on what expenditure? One is for foreign payments. And this is for domestic payment. 1A is for domestic payment. So it is interest, royalty, fees for technical, other sums taxable. So for foreign payments, only for these nature of payments, the provision applies. For others, it is any expense on which tax is deductible. And it is payable to the person here in India is paying to outside India or in India to a non-resident or foreign company, Here it is for resident. So I'm comparing this side by side so that you understand this provision better. What do you disallow? You disallow 100% of such expenditure. And in this case, into the domestic payments, it is 30% of such expenditure. So now whatever we are talking here, 10 lakh is myself, I am a resident. So it is domestic payment. So into 30% is what? 3,33,333. Sorry, I've divided by 3, right? I'm sorry. So it is 10 lakh into 30% is 3 lakh. So this 3 lakh is not allowed as an expenditure in that particular year. But please remember, it is subsequently allowed. Allowed in the year when TDS is paid. So subsequently, let's say this 1 lakh. This 1 lakh was actually provided in the year 2022-23. It is actually deposited to the government in financial year 22-23. In that year, it can be claimed as this 3 lakhs can be claimed as an expenditure. So whatever is disallowed in this year, subsequently when the tax as TDS is paid, it can be allowed as an expenditure. If this TDS concept is so confusing, I guess we'll have to hold on till we study the chapter of advanced tax and TDS. Only then we'll understand. So as far as this business goes, what you need to understand is the concept of TDS is typically something where a portion of income, portion of expenditure is held by the person who's paying. It will be paid to the government on behalf of the person who has provided me the income. So this is what it is about. So this is the example for TDS. Whatever you're saying, an auditor, let's say I am the auditor, a client is supposed to give me 10 lakhs. When he's supposed to give me 10 lakhs, he will give me 9 lakhs and pay 1 lakh to the government. 1 lakh to the government as tax on behalf of me under my name. This I will take this as credit later point in time. So this concept is called TDS. So this is applicable for various transactions, contract, professional fees, rent, commission, and all those things, right? So now in this expenditure, what the law says is, if you have not deducted, or if you have deducted and not paid, if it is related to domestic payment, whatever expense it is, disallow 30%. Do not allow 30% of that expenditure. Subsequently, when the TDS is paid for that, you are free to claim that back. That 30%, you can claim that as an expenditure. If it's case of foreign payments, if it is relating to interest, royalty, fees for technical services, or other sums taxable, all this falls under section 195. So when seeing TDS, this will fall under section 195. Your international taxation is only in your final. So you will not learn about 195 beyond a point. You will only know the basis. So for your intermediate level, what you need to understand is, if it is relating to foreign payment on which TDS is not being deducted, 100% of such expenditure is disallowed. So please remember, for intermediate purpose, what you need to remember is, if it's a foreign payment on interest, royalty, or fees for technical services on which TDS has not been deducted, 100% of such expenditure is disallowed. Whereas for domestic payment, it is 30% is disallowed. So what you need to remember is only this with respect to TDS under PGBP. The rest of the thing probably you will understand in detail in respect to chapter advanced tax or TDS. So that's what it is. So we'll have a couple of problems for this. I'll solve this problem in case if you're still not understanding, probably we'll try to work out it. So Delta Limited created the following amounts to the account of resident payees with respect to the month of March 22 without deduction of tax. So they themselves have given without deduction of. So this is how your question will be. They themselves will say without deduction of tax at source. What would be the consequences during the financial year 22? Assuming that the resident pays in all the cases mentioned below. So they have also said it is resident. So what is disallowed? 30% of the expenditure. The first expenditure that they are saying is 12 lakhs, correct? So in 12 lakhs, what do you do? 12 lakhs, what do you do? If it's relating to 12 lakhs, for salary, TDS should have been deducted under section 192. So this TDS has not been deducted, credited and paid in March 2022. So for which they have not deducted TDS. So automatically 30% of this, that is 3,60,000. So 30% of 12 lakh is 3,60,000 is not an allowed expenditure. Similarly, for directors, this 28,000 TDS should have been deducted. It is not deducted. So 30% of this 28,000 is also deducted. So these two expenditures, that is 3,60,000 and 28,000, 30% of 28,000 will be deducted. So what will be the answer? So salary 12 lakhs into 30% is 3,60,000. Director 28,000 into 30%, that will be how much? 6,000 plus 2,400, 8,400. So 368,400 will be disallowed under section 40A. Okay, technically speaking, it is 41A, but as I told you, it is okay. Disallowance on non-deduction of TDS, it is okay. You need not specifically state 40A. You can always say disallowance on non-deduction of TDS. It is completely, perfectly fine. So that's what it is about. So the next illustration 11. Illustration 11 says, during the financial year, the following expenditures are made, incurred by Yuvan Raja. So Yuvan Raja is an individual, resident individual. Please understand the word, resident individual. Turnover during the year 21 is 99 lakhs. So they have given a turnover of 99 lakhs. So interest of 45,000 was paid to Ragaman and Co., a resident partnership firm, without deduction of tax at source. So they have paid some interest. So there is tax deduction on interest, which has not been done. So 30% of 45,000 will be deducted. So now this question, probably you will have a different answer when you're actually understanding the provision of TDS itself. I'm not going to do that. So if you're reading the answer in your study material, it will be different. What I'm going to do right now is, I'm going to right now tell you, if tax has not been deducted, if tax has not been deducted, what is the process? So I'm not going to tell you whether TDS is applicable or not on this particular clause, because that's a separate chapter. So if your study material has a different answer, it might be different, because what I'm going to tell you is, what is the procedure if tax has not been deducted? I'm not going to tell you whether tax must be deducted in this transaction or not. That's a different chapter. So assuming this tax is supposed to be deducted, interest of 45,000 was paid to Ragman Co. If tax has not been deducted, you will have to deduct 30%. So tax must be deducted at 30%. Okay, so that's what it is about. Then what are we telling? We are talking about, the next thing that we are talking about is 10 lakh was paid as salary to a resident individual without tax. So 10 lakh, 30% is 3 lakh is not allowed. 16,000 was paid to 27 without deduction of tax at source. Again, here also what happens, if tax has not been deducted, you will have to actually deduct it. So in every case, I am assuming that tax must have been deducted by this person, Raja. So that's what I'm doing. I'm not going by whether it is actually deductible or not deductible. So that's a provision about this. So other sections on 40A or this, you can probably read out things. So basically certain taxes, whatever is relating to taxes, any rate, that is your income tax or whatever taxes, are not allowed as an expenditure. So whatever interest, if you have paid income tax, it is not an allowable expenditure. So payment of income tax or interest on income tax is not an eligible expenditure. So that will be disallowed. And similarly, any amount paid by specific royalty license fee to a state government undertaking. So I am paying a royalty license fee, service fee to a state government undertaking. That is not an eligible expenditure. Salaries payable to outside India on which tax has not been deducted. So that is also not allowed. So earlier we saw interest, royalty, technical services. Now we are seeing salaries payable outside India. So here it is 100% of salary is not allowed as an expenditure. Effective arrangements for tax deduction on payment made from provident fund or other funds to employees. So typically whenever I'm making any payment to employees, I should make sure TDS is deducted on that. So whatever deduction I am making, TDS must be deducted. So whenever I'm making a contribution to PF, it is part of my salary only. So on salary, TDS must be deducted. So this is nothing but, don't confuse this. Please remember, you should have actually deducted tax on salary. If you have deducted tax on salary, it is okay. If you have not deducted, it is completely disallowed. So that's what it is. So we said 30% of payment is disallowed. So that provision is linked to this only. So don't remember this as a separate provision. Tax paid on non-monetary perquisites. Basically, when perquisites are being paid, the duty of tax deduction on non-monetary perquisites is in the hands of the employer. It is not an allowed expenditure in the hands of employee. So whatever tax has been paid on non-monetary perquisites is actually not an allowed expenditure in the hands of employer. So that's what it is. These are all basic things. When I say basic things, these are all whatever is listed what will come in your question in case it comes. So your taxes are not allowed. Salary paid to a non-resident, if non-deduction is there, not allowed. Whatever relating to contribution of PF or whatever it is, wherever tax is supposed to be deducted, arrangements should have been made. When you say arrangements, it should have been paid, or it should be in a situation where it will be paid subsequently. And then tax paid on non-monetary perquisites. So when you say tax paid on non-monetary perquisites, it's a duty of employer to pay tax on it. So whatever is paid, it is actually not an allowed expenditure. in hands of employer. So tax paid on non-monetary perquisites. So these are all section 40A. So with this, I'll just hold on and answer some of your questions and then come back. Pooja, income tax is very vast. Yeah, of course. See, that's what I'm saying. See, some of the thing is, you know what is important for your examination. Know that alone. That is one of the thing. Second thing is try to interlink the provisions and understand. Whenever you're remembering something, just remember the multiple provisions that are linked to it. So that will help you understand it. And then have the study material will be so detailed. But if you see in my presentation, I'm trying to give it as a crux. So probably if you're refreshing through the slides before your examination or whatever, you'll have a good recap or something that will also help you. So probably you can only do these things to see that you remember it better. Madhuri, what exactly is freebies? Freebie is, if you have seen, if a medical practitioner, if a doctor is being given so many freebies from a pharmaceutical company, it is not actually allowed. So those freebies are what we have. Freebies means something free, as sample or something given to a doctor for which it is not being charged. That is actually not allowed. Doctors are not supposed to collect free samples, free materials from pharmaceutical companies because it might end up promoting their company alone. So that is not allowed. So that is what we mean. Snega Gupta audit fees. It will come under section 37 because it's a business expenditure, not personal nature, not capital in nature. It is for the accounting year, wholly and exclusively for the purpose of business. So audit fees is allowed under section 37. And similarly, some of you are talking about other insurance, loss of profit and all. That insurance premium is exclusively for the purpose of wholly and exclusively for the business. It is an allowed expenditure under section 37. Mohammad Tawfiq, should every assessee deducted under TDS? No. I'll stop here with this no because it's definitely a separate chapter by itself. So as of now, for the question, I'll say no. Every assessee need not deduct TDS. There are limitations which you will obviously study under the chapter Advanced Tax and TDS. Mansha, whatever we studied in salary chapter is from the angle of employees. So probably I'll not be able to correlate because that talks about what is the deduction eligible in hands of employee from the recipient angle. Here we are talking about from the payment angle. So that's where if I'm actually correlating, there will be no correlation because if we talk about pension, we spoke about what? Commuted pension, uncommuted pension. We said about how much 1/3 of commuted pension is allowed as a deduction. It has nothing to do with what we are discussing in PGPP. Here we are saying if it's a pension, if it is towards 80CCD, that is National Pension Scheme, we are saying up to 10% of salary is allowed. Beyond that, it is not allowed. So it has no correlation. What we are discussing there is employee's perspective. What we are discussing here is employer's perspective. These are two different things. It has no correlation at all. So probably you can only remember PF there we said if it is more than 12%, it is an income in hands of employee. Here we are saying employee contribution paid even 1 day late is not allowed. Again, there is no correlation. I can only tell you what is a provision here, what is a provision here. There is no comparison because that is from the angle of employee. This is from the angle of employer. These are two different things. So I can only tell you the provision, what it is here, what it is there. So probably just know what is there in salary. For employee, here you know what is there. In employer, it is very simple. You need not confuse itself. In employer, if it is relating to pension, it is 10%. If it is related to provident fund, whatever is the contribution is allowed. Only thing in case of employee, if it is late, it is not allowed. So otherwise, there is no nothing big thing to remember in employer's contribution. So from the angle of PGBP, if it is provident fund contribution, it is allowed expenditure provided it is paid within the due date. So that's the only thing that you need to remember. Mohammed, another question on TDS. I'm not going to answer that. Payment to non-resident for import of goods to be deductible TDS. You will definitely learn that in Advanced Tax TDS chapter. It has nothing to do with what we are studying here. What is the meaning of souvenir, Ritesh? See, souvenir is something like, let's say, a gift or something, a small gift or small, you call this as merchandise, right? For example, let's say if you're an IPL fan, you'll have t-shirts, right? Mumbai Indians t-shirt, Chennai Super Kings t-shirt. So that t-shirt is a merchandise. So they will have their own keychains. They'll have their own gift items, right? So if you're purchasing that, that is a kind of, if that's given to you free of cost, that is souvenir. So souvenir is a small gift kind item which provides the, which tells you the brand, which is a branding activity. So that's what souvenir is about. It's more of advertising concept. Tips to study income tax. See, as I told you, how to remember or what tips you need to know is basically, it is important for you to link different provisions wherever possible. So link the different provisions wherever possible and try to understand it. Try to have a flow. For example, as I told you, there is a structure, right? 30 to 37 are all admissible deductions. So this is a crux of activity. Now in 30 to 37, what are all the sections? 30, 31, 35. So probably keep repeating it and keep writing it, keep practicing it to understand this flow. Every chapter will have a flow. Salary, 3 sections, 15, 16, 17, there is a flow. 17, 1, 2, 3. 1 is salary, 2 is perquisites, 3 is profits in lieu of salary. There is a flow. Every section, every chapter will have a flow, will have a content flow. So if you are actually linking it and understanding, it will be very easy to understand. There will be no difficulty to understand. So first of all is to have is be confident. First, believe that you are able to remember this. You are able to understand this. You are able to bring whatever is in the book into your exam paper. So you are able to write it in the confident manner. So that is the first tip I would like to give you. Probably even the last tip. So that confidence, that belief only will help you remember and help you understand. Any other shortcuts, if you ask me, you'll have to link it and study. You'll have to understand the flow and keep practicing. That's what probably I could tell you. So we'll move on to the next section that is relating to 40B. 40B is relating to provision, remuneration of not deductible in the hands of partners. So what is not deductible under the hands of partners? So first of all, what is allowed? To claim this remuneration or interest, to claim remuneration, the partner must be a working partner. When you call a working partner, the working partner is a partner who is actively involved in the business. So remuneration is not allowed for partners who are not working partner. That is your sleeping partner, all those things, right? So it is not allowed for them. And similarly, to claim this, it must be authorized under the partnership deed. So only if the partnership deed says interest can be provided or salary can be, remuneration can be provided, only then it is allowed. So unless it is provided in the partnership deed, it cannot be provided. So however, with respect to interest and remuneration, in accordance with the partnership deed, shall be allowed as follows. So what is allowed? As far as interest goes, maximum of 12% per annum is allowed. Maximum of 12% is allowed. Remuneration paid to a working partner. So as far as remuneration goes, for the first 3 lakh of book profit, when you say book profit is before providing this remuneration. Book profit is before providing this remuneration. For the first 3 lakhs of book profit, it is 1.5 lakhs or 90% of book profit, whichever is higher. So if your profit is more than 3 lakhs, automatically what will be there? Let's say my profit is 3.5 lakhs. So for the first 3 lakhs, what do you say? You say 90%, that is 2,70,000. And then you have a limit of 1,50,000. You say whichever is higher. So you take this 2,70,000 is for the first 3 lakhs. For the next 50,000. So for the balance 50,000, what does it say? It says 60%. So it is 30,000. So the total will be 3 lakhs. That is 2,70,000 plus 30,000. So that's what it is. So the balance book profit, it is 60%. So for interest paid to any partner, 12%. For remuneration, for the first 3 lakh, it is 1.5 lakh or 90%. Why do they have this? Basically to say, even if you have a loss, you are eligible for a remuneration of 1.5 lakhs per annum. Please understand, even if you have a loss, you are eligible for a remuneration of 1.5 lakhs. And this is together of all the partners. It is not per partner. It is together of all the partners, not just one single partner. For all the partners, the maximum will be 1.5 lakhs or 90% of first 3 lakhs. For the balance book profit, it is 60%. Please remember, it is all the partners put together, not one single partner. So we'll understand this with the problem. The firm has paid 7.5 lakhs as remuneration to its partner for previous year 21-22, and it has a book profit of 10 lakhs. So the book profit is basically 10 lakhs. Whatever the book profit that we are saying is 10 lakhs. Now we need to understand the provision. What have they paid? They have paid 7.5 lakh as remuneration, correct? They have paid 7.5 lakh as remuneration. So we need to do how much? So first 10 lakhs, correct? For the first 10 lakhs, 10 lakhs. How do you split? You split it as 3 lakhs and then 7 lakhs. For the first 3 lakh, 90%, correct? Or 1,50,000. So of course, you'll have 2,70,000. For the 7 lakh, 60%, that is 4,20,000. So what will be there? 6,90,000. So what will be allowed is 6,90,000. So out of how much ever 7.5 lakhs, out of 7.5 lakhs, what will be allowed as partnership remuneration is only 6.9 lakhs, correct? 6.9 lakhs. So that is what will be allowed. The second question, Rao and Jain partnership consists of 2 partners, report as net profit of 7 lakhs before deduction of following item. Salary of 20,000 to 2 working partners. That will be allowed only later, so we can leave it. Depreciation of 1.5 lakhs. Interest at 15% per annum. How much is allowed? Only 12%. So I'll have to compute book profit. So this is what illustration? Illustration 12. So this is illustration 13. So I'll have to compute book profit. So basically I start with the profit. What is the profit? 7 lakhs. Less depreciation. How much is depreciation? 1.5 lakhs. And less, add interest, excess interest at 3%. So the actual interest eligible is only, it has not been provided in the books, right? So less interest at 12%. So what is eligible is only 12%, not 15%. So we only have to take 12%. So if 15% is the amount of capital eligible for interest is 5 lakhs. So in this 5 lakhs, you compute 12%, that is 60,000. So this has already not been provided in the books of account. If it is provided, you will have to adjust 3%. Now, since it is not provided itself, I'm reducing 12%. So 7 minus 2.1. So it will be 4,90,000. In 4,90,000, what happens? For the first 3 lakhs, it is 2,70,000. For the next 1,90,000, it is 60%. So how much it will be there? Into 60%. So that is 1,14,000. So total is 3,84,000. 3,84,000. What is actually provided as salary? Salary provided is 20,000 for each per month for 2 working partners. So 20,000 into 2 into 12. So it will be 44.8 lakhs. But what is only allowed? What is allowed is only 3,84,000. What is allowed is not 4,80,000, it is only 3,84,000. So that's how you compute partnership remuneration. So I'll answer some of the questions till this section. Hitesh Jain, is nominal partner also not allowed? No, only the working partner is only allowed. So any other partner is not allowed. So basically, when you say working partner, they must be actively participating in the day-to-day, in the management of the partnership firm. So that's what you need. So any other namesake partners, whatever name you could call them, is not allowed. Pooja, some other problem for practice is typically I would suggest you solve RTPs. So you go through the RTPs that are available. Probably the last 2 or 3 RTPs is relevant for your examination. So your questions will predominantly be from your study material, last 3 RTPs. So this is what your questions are more relevant. So if you can go through the last 3 RTPs, the study material, problems in study material, it will be very important. And always give weightage to amendment. Wherever we are studying that it has been amended in Finance Act 2021, it has more weightage. There is a probability that it will be questioned in your November examination. So that's what it is about. Right? Okay. Mansha, Form 16 issued to employees is same as for books of employer as CTC. See, as far as your Form 16 is concerned, whatever you have is CTC. In CTC, you have various components, right? So as I told you, your salary might include, when you say CTC, it includes various components. It includes salary, bonus, allowance, PF. All this will be part of it. Some whatever. So any other components. Okay. Now your Form 16 will talk only about taxable components. So how much of this is taxable here? How much of this is taxable here? How much of this is taxable here? So in everywhere you talk about taxable component and then prepare Form 16. So Form 16 is the taxable income of an employee. But what an employer is giving will be a different amount. Let's say CTC is 10 lakhs. Form 16 taxable income could be even 5 lakhs. Why? Because there are so many things that will come into Form 16. Your house property loss, your loan from house property, your interest, any other income that you're reporting to your employer. So all this is what Form 16 about. So that's what I'm trying to tell you. Don't compare employees angle and employer's angle. These are 2 different things. What employer gives is not the thing what is taxed for employee. Sometimes employee is taxed more. Form 16 will also include income from house property. But what we are talking from employer's angle is only the contribution, the salary paid to the employer, right? So typically these are 2 different aspects completely. Illustration 13, they have written provision on book profit also should also write this exam or directly do numerical part. See, you should solve the problem. So if you actually look at the illustration 13 here, I just go to that. Where is it? We are ready to come to illustration 13, right? Okay. The illustration 13, whatever we have discussed here, typically what you need to do is first you need to compute the book profit. You need to compute the book profit. So whatever is the book profit is what you need to compute. Why should you compute that? Only then you will know how much has to be allowed or not allowed. So the first calculation is about calculating book profit. So that's what we did here. So the book profit calculation is this. So you first calculate book profit and then work out whatever it is. So you need not write anything provision on book profit and all. So you first calculate the book profit. When you're writing this book profit, you'll have to write it a little detailed. Depreciation, if you know the section, depreciation under section 32. Otherwise, just write depreciation. Interest, if you know the section, write the interest, 40B. Otherwise, you write interest at 12% on 5 lakhs. You can write it like that also. So you have to write the description as much as possible. Okay. So now we'll move on to the next topic. That is in 40A itself, 40A itself, subsection 2, clause 2, where it talks about related party transactions. I'll first tell you what is the impact of this. I'll tell you the impact of this. Now let's say A. Okay. A's father is B. A's father is B. Now B has mobile shop. I'm again coming back to the own gadget example. Please excuse me. Probably that only comes to my mind straight away. Now, let's say he sells iPhone. Now A buys from B. Since A is the son, the cost of 70,000 worth rupees phone, okay, is actually purchased for lower price. Let's say it is purchased for 50,000, correct? Now, according to A, the expenditure is only 50,000, but the real expenditure should have been 70,000. Okay, this is one way. Now, look at the other way around. What if you're paying extra? Why should you pay extra? Now, A runs a business. Okay, A has a business. A says, see, I cannot pay more tax. So, Dad, why don't you give me an invoice for an iPhone for 80,000? So, what will happen? A will book 80,000 as an expenditure in his profit and loss account. So now A is increasing the expenditure by 10,000. So that profit, so expense goes up, profit comes down. So tax also comes down. So I am escaping tax. How am I able to do that? Why am I actually buying 70,000 phone for 80,000? Because I know my money and my father's money are not two different things. It's the same money. So I am okay. Instead of having it in my pocket, let me give it to him. So it could always happen, right? So it's possibility. So what income tax says is, if you're having a transaction with related party, and if you're making any expenditure that is excessive or unreasonable. What do you mean by unreasonable? It is beyond the market price. So if you have an expenditure which is excessive or unreasonable, so the fair market value in our example for the iPhone was 70,000. But how much did A pay? He paid 80,000. So this difference will not be allowed as a deduction. So what will be allowed as a deduction? Only 70,000 will be allowed as a deduction. Only 70,000 is deduction. This balance 10,000 is disallowed. Is not allowed as an expenditure. Is not deductible. So that's what we are saying. It is not allowed as a deduction. What is not allowed as a deduction? The excess amount paid or unreasonable amount paid to a related party. So now we should know who is a related party, correct? Who is actually called as a related party. So from the angle of individual, if individual is assessee, relative is a related party. Who is a relative? Spouse, brother, sister, any lineal ascendant, any lineal descendant. So which means father, grandfather, everyone are lineal ascendant. So lineal descendant is son, grandson, or great grandson, whatever it is. So spouse, brother, sister, and the parents, lineal ascendant and lineal descendant, are actually called as relative under the Income Tax Act. Now, if this individual has transaction with the relative, individual has a transaction with the relative. So this is what in our example we said, this is A, this is B, correct? So this is, if there is a transaction expenditure, then the excess expenditure will be disallowed. So now, if the individual is paying 80,000 instead for a 70,000 phone, the 10,000 is actually disallowed. Next, if the individual or the relative owns substantial interest in a business, in any business, any person carrying on a business. So in some business, they are owning substantial interest. What do you mean by substantial interest? They own 20% of voting share or profit, 20% of voting share, or in case of its partnership firm or something, 20% of profit. So if the relative or individual owns this substantial interest, please understand it need not be independent, it can also be combined. If individual owns 15%, relative owns 7%, it is 22%, correct? So it is still substantial interest. So it can be combined also. It need not be independent. If combinedly, if in a combined manner they're having substantial interest also, it is included. So remember this, for an individual, if an individual, the related parties are relatives of that individual, or the entity, the business in which this individual or the relative own substantial interest. So that's what is actually called as related party. Now we are going to expand this for other organization, that is company or something. We are going to expand this for company or something. So this is a much detailed thing. Start from here, okay? This is the primary thing. So what I'm saying is, if a company is a person, that is an associate is a company, who are all the related party? A director is a related party. Relatives of the director are also related parties. So for a company, directors are related party. Relatives are directed. Relatives are also relatives of the director are also related party. And if another company owns substantial interest, another company owns wherever I have stated SI, it means substantial interest. So if a company has substantial interest, then that substantial interest, that company becomes related party. So now this company becomes substantial interest. Not just that company, the directors of that company, the relatives of the director, everyone becomes a substantial related party. Please understand, when a company owns a substantial interest in another company, not just that company, the directors of that company, the relatives of the director, everyone becomes a related party. Similarly, if there is one company, okay, I'll just give you an example. A Limited. Now, B Limited owns 30%. So now A and B are related, correct? A and B are limited. We are talking from the angle of A. This is the associate. So for A, B becomes a related party. Now, B has 30% in C Limited. Now, C is also a related party. Why? Because they are fellow subsidiary. Because they become fellow subsidiary. So if one company has investment in two companies, these two companies become related. So here in our example, A and C become related, correct? So that's fellow subsidiary. If it look like confusing, it's never confusing. You can always freely look at this one slide and understand the entire relationship that we are talking about. It starts from here. We are talking about all the relationship. A director, relative, director of the company, relative of this director, a company which has substantial interest in the associate, the director of the company, relative of the director. So, and fellow subsidiary. Fellow subsidiary also become related to this company. And when a director owns substantial interest, what happens is, if the director is a director in any other company, that company, directors of that company, relatives of such directors. Correct? So that's what it is. I'll again take up an example. A Limited has two directors. Let's say B and C. B owns 98%, C owns 2%. Now B is the director with substantial interest. B anyways is a related party. Why? Because B is a director. Now B owns what? Substantial interest. Because B owns substantial interest, let's say B is a director. B is a director in C Limited, D Limited. He does not own substantial interest and all. B is just a director in D Limited. Now, D Limited has two directors, B and E. Now, E is also a related party of A Limited. Why? Because B owns substantial interest in D Limited. E is a director of D Limited. So, E and A are also related party. So, that's what we are saying. Other company as director, other directors of such company, relatives of such director. So, when a director owns a substantial interest in a company, not the director alone is a related party. The other company in which he is a director, other directors of such company, relatives of such director. Please understand that. So that is what this column is all about. Now we have discussed all this. We'll come to this side. Now when an individual owns substantial interest in company, he is not a director, a general individual who is owning a substantial interest. The individual and relative of that individual becomes related party, And the last thing is that I wanted to tell you is, we said director, relative of directors. If they own substantial interest in any other business, then this company and this person automatically becomes related party. So now what are we saying? We are saying A Limited, B is a director, C is also director. Now, B has invested in D and Co, a partnership firm. He owns 40%. So A Limited, B is a director. B has substantial interest. In D and Co. Now D and Co and A are related party. D and Co and A Limited are related party. So that's what this diagram is about. Now a small additional tip. One more tip. Here I've said company, okay, and I've said director. Now, if you wanted to understand this from a partnership firm angle, you can replace this company with partnership firm. You can replace this director with partner. Please understand, this diagram is common for company, partnership firm, everyone. So, if you wanted to understand from the angle of partnership firm, this company becomes a partnership firm. Moment this is a partnership firm, this becomes a director. Instead of director, this becomes a partner. So if it is, this is applies to everyone. So wherever you want, you can replace company with partnership. You can replace director with partner. So that becomes another table by itself. But the point is, this is how it is related. Directly, indirectly related. So that's what the relationship is about. So take time and go through these two slides related to related party, so that we can, you'll probably understand the exact crux of the relationship that we are talking about. So these two are excellently put across in one single slide rather than just a theoretical form of what it is about. So typically you will understand this much better if you just understand this diagram. So it's a diagrammatic representation of the entire stretch of related party. So please understand this. It is a very simple exercise. Only wherever I've said SI means substantial interest. Only with substantial interest, they become related party. If it is like this, just a flow here, they automatically become a related party without substantial interest also, like director to a company, relative to the director. So that's what we are talking about. And everywhere, the relationship is finally to the company only. We are talking only about the company. So this relative is directly linked to the company. This relative is also linked to the company. So this relative of such director is also linked to the company, correct? So that's what we are actually talking about. So that's about 40A2, which talks about related party. So once you know they are related party, in case if there is any expenditure which is excessive or unreasonable, that portion will be disallowed. So for exam purposes, probably to make you feel better, probably in examination point of view, you will not be tested with whether they are related party or not. You will be tested only with adjustment to that related party transaction. So you may generally not be tested to understand whether someone is related or not related. What you will be tested is only relating to whether how much should be disallowed or not. So typically you can feel free and ignore this also, but this is a very critical section even in your final. So probably just understand what exactly it is. Okay, next section is 40A3 and 3A. So 40A3 is basically cash expenditure more than 10,000. Cash expenditure more than 10,000 to a person in a day. To a person in a day. So per person per day is what we are talking about. So if I'm paying 5,000 to A, 6,000 to B, put together it is 11,000. That's not what we are talking. 2A if I'm paying more than 10,000. 2B if I'm paying more than 10,000. That's what we are talking about. When I'm talking about payment, you should not only consider about current year expenditure. If there is some payable, if some payable in the earlier year, for example, there is an outstanding. Let's say there is an outstanding of what you call some. Let's say creditor. So there is a creditor on 31st March 21. The balance was 25,000. On 15th June 21, I am paying 25,000 by cash. So this is also disallowed under 40A 3A because earlier year it has been an expenditure for which I am repaying by cash. So it can be current year expenditure or previous year expenditure. Still, it is not allowed. And in case it is relating to hiring or leasing of goods carriages, if it is related to that business, the limit is not 10,000, the limit becomes 35,000. So the limit is not 10,000, the limit becomes 35,000 in case of this business alone, plying, hiring or leasing of goods, leasing goods and carriages. So for this business alone, the limit is not 10,000, the limit is 35,000. Can we say that cash is not at all allowed? Of course, there must be some exceptions, right? So some of the exceptions, first is payments to small industries. When you say small industries, relating to agriculture and relating to business without power. So you are manufacturing without power, a cottage industry where manufacture is happening without power. So to this, if you are making any payment to this, then it is okay. So this payment to small scale industries. Second is bank unavailability. Third is salary payment. So when you have a salary payment, basically to a person who have quit, you're settling him. He has quit the employment. He's basically what? He's no more. He's passed away. The employee is no more. Now you are making the payment. Either he's no more or he is just quit. You are either making the payment to the employee or the legal hire of that employee. So if it is less than 50,000, it can be paid in cash. So termination benefit payment paid to the employee or legal hire up to 50,000 is okay. Similarly, if you are making salary payment to a person who's in traveling for more than 15 days, and he does not have a bank account in that place, then also it is okay. So typically I'm paying to an employee who's traveling. Let's say his place is actually Mumbai. Now he's traveled to a down south in a local interior village in Tamil Nadu. He's there for more than 15 days. Of course, he doesn't have a bank account there. So he needs cash. Then cash can be given to him to meet out because bank is not available there and he has been traveling for more than 15 days. So that's what it is. Other than that, the miscellaneous thing is anything paid to government, bank or LIC can be paid in cash. So whatever you are making payment to government or bank or LIC can be made in cash. Principal to agent, where you are making payment for goods on behalf of principal. You are not paying for you are paying on behalf of principal. Principal has paid you money. So that can be paid in cash. There is no restriction. Similarly, foreign currency exchange. If relating to foreign currency exchange, if you are converting any currencies, you can pay by cash. So these are all exceptions. Let me repeat, what are all the exceptions? Payment to small scale industries, unavailability of bank, salary payments for termination and traveling persons, other cases, that is your bank, RBI, principal agent relationship, and forex transaction. So these are the broad categories in which you can still make payment in cash and it's still allowed. So this is discussed in section 40A, 3 and 3A. So with this, I'll stop and probably answer some of the questions and wind up. Sandhya, if someone purchased machinery and paid 30,000 as freight charges for his business and paid through cash, then will complete 30,000 won't be included the actual cost of machinery. See, freight charges, whatever capital asset, towards capital asset, if you're incurring any expenditure, till it is put to use, it must be capitalized. If in that case, if you are actually making any payment out of cash, that expenditure should not be included. So in your case, if you have actually paid the 30,000 through cash, 30,000 will not be included. The entire 30,000 will not be included. If it is crossing above 10,000, the entire amount is disallowed. The entire amount is not included. So that's what it is. Raghavan, spouse, parents are included? Yeah. Spouse, brother, sister, spouse, lineal ascendant, descendant are also relative. Sandhya, oh yeah, I have not uploaded 13th June. I'll probably do it today. I will upload the notes of 13th and 15th by tomorrow morning. I'll upload it tomorrow morning. So any other questions? If not, probably I'll complete just one slide alone, because with that the 40A completes. I'll complete this slide alone and I'll close this class. So 40A7 is for gratuity. Very simple. Please understand, any provision of gratuity is not allowed. Any provision of gratuity is not allowed expenditure. Payment of gratuity is allowed. Whenever it is paid, it is an allowed expenditure, but creating provision is not allowed. Creating provision for payment of gratuity is not an allowed expenditure. Payment of gratuity is allowed. That's all you have to remember. Whatever is a provision is disallowed. Whatever is actually paid to the employee is allowed. And 40A9, we have already seen, whenever it is deposits towards provident fund, superannuation, gratuity, or whatever, employee welfare schemes, pension, whatever it is, whatever is the limit specified in 36 for employer contribution, employee contribution, the pension restriction of 10%, till the restriction provided in that particular section, it is allowed. Beyond that, it is disallowed in 40A9. So whatever is allowed is only till the limit specified in section 36. Beyond that, it will be disallowed in section 40A9. And in case if you are setting up any trust or any association to manage all this fund of employee funds of that, setting up expenditure of such trust or whatever is not allowed. So no deduction shall be allowed in respect of any sum paid towards the setting up for or as contribution to institution, other institution for any purpose. So you are setting up a trust or whatever it is for managing this fund, provident fund, superannuation, gratuity. So for setting up whatever you have incurred is not an allowed expenditure for employee welfare scheme. And any deduction and for employee welfare scheme, provident fund, superannuation, gratuity, pension, the limit provided in section 36 only is allowed. Anything beyond that is not allowed. So one of the limit we discussed is 10% right of for national pension scheme. So beyond 10% it is not allowed. So that's what it is about. So with that, I'll close if there are no more questions. I'm actually sorry. I have not uploaded 13th June PPT also. What I will do is 13th June and 15th June, today's PPT, I'll upload it tomorrow morning, both the days PPT. The next class will be on 17th. I'll meet you all on 17th. So if there are no more questions, I'll probably wind up. I think the questions are that's all. So I'll stop it here. So we'll see in the next class. Thank you for the wonderful session. We'll meet on 17th June. Thank you. Yeah, concluded.